In this video, we're going to explain why these 14,700 unusual options on Bank of America is a no risk strategy where this large institutional hedge fund is making $500,000 in a month risk free. Okay, so without further ado, let's get right to it. And so these options came in today, June 21 at 10:49 a.m. You'll see this is July 21's, 23 strike calls and 23 strike puts. Okay, so remember this, the pricing here, $5.95 and 4 cents on the puts. Okay, so when we take a look at this July 21's, the 30 days out, you'll see, so 1 month out, you'll see these 14,700 are here at the volume and also on the put side as well. Okay, so what they're doing here is they're selling this call, and we know that was $5.95, so we can change that when they did their trade. Let's analyze this trade, add it into our analysis, and now let's add the put side in. So if you remember, the put side was 4 cents, so they bought the puts and they sold the calls. And when you analyze it, you'll see that it does look like a short position, because as the price of Bank of America at $28 goes down, this becomes profitable at expiration, right? Because it's above this zero line. And if it's below, it's a loss. So you'll see that this is now below once the price increases. So it looks like a short position. However, that's not the case. Let's also change this back to today's date, June 21. It doesn't matter too much because you'll see that the theta doesn't really affect this kind of a trade. And that's why the purple and the blue line are about the same here. So the reason why this is not the complete trade is because this large institutional investor or hedge fund also has 100 shares of Bank of America. And so when you add this into the trade, you'll see that for every one of these options that they have also 100 shares, which is what a covered call strategy is for every 100 shares, you would sell one call, right? So this is actually a very deep in the money call that they're selling. And so what you see here, once we analyze this now and have all of this in, is that as the price actually goes down, it's never really going to lose any money, right? In fact, it comes right back up to the max profit of $35. So the blue line is the expiration line. So as we start to get to the 30-day of expiration on July 21, you'll see that it will become that blue line. So you'll see here 35, that's the profit, right? So the zero, there is no zero anymore. There is no loss. So anywhere the price of Bank of America, where it goes, either goes up or goes down, they will make their $35 per trade, right? Because this is only one trade. We know they did 14,700, right? So 14,700. Let's add that all in, put it all in. That's 14,000. So for the shares also, what you'll have to do is we'll first put the 14,700, then add in 2 more zeros by multiplying by 100 to get the total stock price, or the total stocks. And so look at that. Now that you have everything in, how much is this? This is $514,500, $500,000, right? So this is what they're doing. They're just, after 30 days, they get this amount, $500,000. Okay, so in percentage terms, obviously you need a lot of money to put down to do something like this. So if we go back to our original calculation of just having 100 shares of the stock, let's say at $28.56, we could calculate kind of the percentage of what this was giving them. So $28.56 is what the share price is for one share, 100 shares. So you need about $2,856 for 100 shares. And so because it was a $35 profit that we were showing initially with just one trade with 100 shares, you divide that by the 2,856 to get a percentage, right? Times 100 to get an overall percent, and that's the percent that they're getting in 30 days. This 1.2% gain, risk-free, right? And that's per month, right? 30 days. And so if you multiply that by 12 months, that's 14.7% gain in a year, right? So that's better than the average stock market return of 10%, right? So this is one of the ways you can bring in steady cash flow, percentage gains with no risk. And so hopefully this was something, you learned something, and you can smash that like button. And if you enjoyed this video, learned something, and this is how the large hedge funds and institutional investors continue to get rich and make more money. And so for our analyses, though, and the way we trade, we want to beat this 14.7% annually, right? We want to beat that, and that's what we do. And because we are looking for better returns, and so there is risk. You have to take on some risk, but you can make a lot more than 14.7% per year. And that's what we want to do. We want to use the data from the large institutions, using that to our advantage, and we trade options or stocks. We can do both, either way, and gain more than this 1.2% per month. Okay, and if you are interested in more of the different stocks to diversify your portfolio, we do analyze other stocks as well for our members in our private membership group. For our members, exclusive videos, you can get access to those if you're interested. Also in how we trade, by clicking on our channel homepage, there's a join button, and take a look at that if you're interested in making more money and gaining higher returns than this risk-free strategy that we just showed you. All right. As usual, please smash that like button and subscribe if you haven't. Hit the bell icon. You'll be notified whenever we detect unusual options activity. Thank you, and take care, everyone.